Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Despite the false Wall Street sell-side optimism, there is a recession coming to the United States, and it is not going to be one that could be labeled as even remotely a soft landing. I want to show why, what to look for to confirm this, and when we currently expect it to arrive. As such, I want to cover the items outlined here. Sometimes we show a lot of charts which can potentially cloud the implicit message that needs to be heard. I'd like to therefore start with the key messages that are in the charts, which I'm going to take us through. First, there are real consequences of a monetary policy period that held interest rates too low for too long. This has led to not only elevated asset valuations, excess leverage, and historic debt levels, but also changes that are clouding what have been historically reliable warning statistics. Examples are smart borrowers have locked in low borrowing rates. We have a structural demand problem, and we have witnessed an increasing shift to foreign borrowing to finance the U.S. standard of living. Secondly, Bidenomics has confused the signals within the credit transmission mechanism, and the scale of lending has the potential to shift to former, more balanced financial control from monetary policy to fiscal policy. The result may be that Paul Volcker's proven liquidity solution to solving inflation may now be in jeopardy. Thirdly, liquidity is obviously the dominant control of financial markets today, but must now be monitored differently, as listed here. And fourth, the complications of the world shifting from a unipolar world to a multipolar world are profound, and the geopolitical fallout is increasingly driving investment strategies. The big picture needs to be in the forefront of our minds to better tie these messages together. Quantitative easing was initially launched as part of the recovery effort after the 2008 financial crisis. It was aimed at lowering interest rates to bring demand forward and to help propel their recovery. It was continued in multiple waves, with each wave being less successful as demand pull stealthily fell with corporate revenues weakening. Though CEOs often cited top-line revenue growth rate concerns, it was always overshadowed by great bottom-line earnings per share growth as a consequence of low finance rates, stock buyback, and borrowing to boost dividends. Well, that has all come to a grinding halt as rates are now beginning to cramp consumer spending, and demand has become the number one topic of Q3 earnings calls. Also lost in the narrative of rising stock market over the last decade was the consistently ignored fact that the U.S. national debt is now growing faster than the U.S. economy. When your household's debt growth is increasing at a faster pace than your income, you'll likely pull in your horns before the interest and repayment schedule of the debt suddenly puts you into bankruptcy. That isn't the case with the U.S. government, which simply is accelerating its debt growth rate. Like an addict is simply looking for more to satisfy its ever-growing addiction. During this era of monetary malpractice, we went through the expected stages from hedge financing to speculative financing to Ponzi finance until we finally arrived at the point where the rate of credit creation just couldn't be sustained. As it began to fall, the U.S. economic growth has fallen accordingly. Slowly, large government debt needs have crowded out funding that keeps a healthy economy vibrant. The long-term chart of the S&P 500 mirrors the period of the Great Moderation when interest rates continuously fell. Now, however, we have reached the inevitable end where markets need to consolidate to levels that are economically sustainable. We have begun that long overdue consolidation. We are presently trying to find levels that support the rise as a result of what can best be described as the COVID-19 stimulus era. Still in front of us is the whole decade of quantitative easing. The COVID consolidation, based on our analysis, is itself still a long ways from being completed. The real consolidation that is actually required goes all the way back to the bursting of the dot-com bubble, after which over 50,000 manufacturing facilities subsequently left America with China's entry into the World Trade Organization. This effectively deindustrialized America The die was cast, and debt was the only way to keep the U.S. standard of living from necessarily falling. It is important to note how similar the potential consolidation process is unfolding, but on a much, much larger scale. As I have previously said many times since COVID, we have adopted wartime spending in a peacetime economy. The renowned Stanley Druckenmiller last week referred to government spending as spending like a drunken sailor. I think a better analogy is as a crazed crack addict. Unfortunately, it is actually more about the spending obligations this spending has committed the United States to going forward. It is now simply unsustainable, and the world now recognizes that. The 30-year U.S. Treasury yields since the lifting of the debt ceiling in June have begun tracking the U.S. credit default swap rate. It doesn't mean the U.S. will default, but rather it is going to cost the U.S. more on its debt because of elevated risks. Rates are going to be higher for longer, much longer. In our annual thesis paper in January, we were very clear that increased risk premiums for stocks and bonds were ahead in 2023. We are seeing it in bonds, but not yet in stocks. That lies ahead when the coming recession actually arrives. We believe term premiums have increased by a minimum of 1.5% for the remainder of the decade, of what we termed the beta drought decade in our 2023 thesis paper. The full paper is available for download at the Matasi site if you have not yet read it. As a result of this and central bank policy, we are presently experiencing a slow choking of credit. One way of viewing that tightening is through the yield curve, which measures the difference between the 3-month and the 10-year Treasury yield. It has correctly predicted every recession since 1968. Though optimism has grown for a soft landing, the inverted yield curve is still correctly signaling a recession. Many are doubtful of what the yield curve is signaling since the downturn hasn't yet struck. What they are impatiently forgetting is that the yield curve inversion typically lags behind the start of the recession, with the average wait time over the past 4 recessions being 13 months from the start of the inversion. The curve officially inverted on October 26 last year, according to the Fed data, meaning the recession signal is just a few days shy of the 11-month milestone. If history is any guide, that would put the start date of a potential recession sometime in December or January. Though the yield curve has flattened its inversion over the past few months, that's typical behavior, and such a flattening has preceded the last 4 recessions. The indicator is 8 out of 8 when predicting recessions, and it doesn't have any false signals. So it's way too early to say this is a false signal. Maybe it does turn out to be a false signal, but you can't say it's a false signal when you're not even at the average. I believe that a lot of the yield curve's skepticism and soft landing narrative stems from the results of what I will call the Bidenomics factor. I've outlined many times recently how Bidenomics has created stealth liquidity, which is working against the Fed's tightening. I'm not going to review this again, but you can review recent newsletters in the September Under the Lens video entitled The Realities of Bidenomics. Campbell Harvey, the Duke University finance professor who coined the inverted yield curve as an indicator of a coming downturn in 1995, recently stated that he believed the recession is imminent due to the Fed's ultra-tight monetary policy having raised the risk of pushing the economy into a downturn, especially when considering the lagged effect of rate hikes, meaning financial conditions could still be in the process of tightening further as a result of interest rate hikes enacted last year. Meanwhile, quantitative tightening has reduced the Fed's balance sheet to roughly $7.9 trillion near the end of October 2023, down 11.8% from its peak of just under $9 trillion in April of 2022. The Fed has been shrinking its holdings of treasuries and mortgage-backed securities at a rate of about $75 billion a month. Banks have been tightening lending standards for over a year. The Financial Conditions Index has finally kicked in with aggressive readings. Surging bond yields are adding another 75 basis points to the Fed funds rate tightening efforts. Real rates recently exploded higher to approach 2.5%. The tightening of the credit spigot is finally beginning to be felt. It is only over the last 30 to 45 days that we are actually seeing the initial impact. We are increasingly seeing it in the consumer credit delinquencies and bankruptcies, layoffs, continuous jobless claims, falling employment growth, and others. The truth is that the confirmation has been right in front of us all along. We have long held that America is founded and survives on small business and the entrepreneurial attitude that it has been dominant in America. As goes small business, so goes America. I saw a list recently that highlighted the richest 10 Americans. Everyone on that list started as a small business and startup. Not one has been exposed to the stifling environments of corporate bureaucracies. That's not what America is about. Elon Musk, that was rated number 1, has started 6 companies. Jeff Bezos, number 2, founded Amazon. Larry Ellison, number 3, founded Oracle. Warren Buffett, number 4, founded Berkshire Hathaway. Number 5, Larry Page co-founded Google with number 7, Sergey Brin. Bill Gates, number 6, founded Microsoft. Mark Zuckerberg, number 8, founded Facebook. Steve Ballmer was Bill Gates' first employee at number 9. And Michael Bloomberg, number 10, founded Bloomberg. When small business booms, America booms. When small business is stifled, America grinds to a halt. For the last 4 years, small businesses have ground to a halt and are now approaching free fall with these elevated lending rates, the lifeblood of growing small businesses. Financial writer John Authors writes, and I quote, "The proportion of bank tightening rather than loosening standards for commercial loans has now hit almost 50%. It's only been exceeded during the worst moments of the pandemic and the global financial crisis. The net percentage tightening credit standards for small to medium-sized businesses is at a major high last seen during COVID, the 2000 financial crisis, and the dot-com bubble bursting. Small businesses are busy coping with their biggest problem, surging rates. The bottom 50% of the S&P are in deep trouble as the rates have risen. There are serious problems in small cap land, especially in the U.S. Good luck paying interest without profits. Shown here is a great chart from SocGen showing the distribution of stock forward PE valuation. The white bars highlight the serious problem within the Russell 2000 index. Small caps have underperformed large cap by more than 10% in 2023 and are testing decade lows. The seriousness of the problem is highlighted here when you consider that as poorly performing as the S&P 500, excluding the Magnificent Seven, has been, the small caps are at the bottom of it. Russell 2000 even lower, and unlisted companies and the mom and pops are barely holding on coming out of COVID and now can't get funding to survive. This is a profoundly serious cancer within America, which is getting little to no media coverage. The media is more interested in artificial intelligence, which will obsolete more jobs and more small businesses, and the Magnificent Seven, who in prior generations would have been broken up as becoming monopolies within their particular market segments, the Securities and Exchange Commission has failed to categorize properly. So if restrictive credit is slowly choking the lifeblood out of America, how bad could it get, and when might it reverse, or even will it? The central issue is the reality about term premiums. As I highlighted earlier, they have adjusted to reflect the future increasing risk in the financing of the U.S. debt. These premiums are not coming down, though inflation may take nominal values lower. I see little recourse but the U.S. to move towards yield curve control as Japanese was forced to do so. This is not a solution, but will serve to only keep financing going, at least temporarily. The 10-year U.S. Treasury yields have generally traded in the 4.8 to 5% range over the past few weeks until the October labor numbers shook the markets. The high for longer narrative had clearly been adopted by markets, which is visible in the noticeable stable pricing of the SOFR forward curve shown here to bottom at levels around 4% in 2025. Apart from data and monetary policy, bond markets remain highly impacted by supply-demand dynamics encapsulated in the move up in the term premium since the summer. The U.S. debt outlook is in the center of these discussions after the Treasury's sizable upward revision of expected issuances in August. However, recent announcements on issuance have brought some calm to the markets. On October 31st, the Treasury lowered its expected issuances for the remainder of the year while signaling the cash buffer in the TGA, Treasury General Account, is now sufficiently refilled after being drained in the lead up to the debt ceiling resolution in June. According to the quarterly refunding statement on November 1st, issuances for the remainder of the year will be mainly picked up at the belly of the curve, while selling in the long end will decline marginally in December and January. A combined high share of T-bills in the issuance profile indicates that the short end will continue to bear a significant share of the U.S. deficit burdens. Markets had clearly feared a more significant amount of duration to accommodate in the short run. Barring disastrous Treasury auctions, yields should soon settle in a trading range north of 4.3, but below 4.8%. On the demand side, investors still seem cautious to take on more duration risk in the current situation. Powell mentioned in his recent speech at the Economic Club of New York that the FOMC is looking at the current positive bond-equity correlation as a potential driver of term premiums. Bonds have become less useful for hedging risk. Bond and equities share a common exposure to inflation, and historically the two have correlated positively in decades characterized by elevated price pressures, as the 1980s and 1980s shown in this chart. As economic growth slows and inflation risks dampen, the positive correlation will likely recede gradually from here. We expect long rates to decline, but less than many expect. Powell mentioned at the meeting that the FOMC is closely watching the rise in long rates and the implications for financial conditions. To have an impact on monetary policy, the move needs to, 1, be driven by higher term premiums, which according to Powell seems to be, and be persistent. Simply put, a persistently higher term premium would be countered by monetary policy, assuming that financial conditions are to remain unchanged. Nothing indicates an intention from the FOMC to achieve additional tightening, and as long as that is the case, the markedly higher term premium should eventually increase the probability of monetary policy turning softer in the first half of 2024. Reflecting stronger than anticipated private consumption and an ongoing lift from fiscal policies, the U.S. GDP forecasts for 2023 are likely closer to 2.4% and 1.1% for 2024. But as we still expect consumption growth to cool towards winter, and as tighter financial conditions gradually weigh on investment activity, the forecast profile still includes a slowdown in the first half of 2024. Expect a downwards trending profile for long U.S. Treasury yields over the coming year, with higher level expected on a 12-month horizon. We have likely ended this cycle up in yields, but it will be resumed in the second half of 2024 at the latest. We expect the 10-year U.S. Treasury yield to decline by about 70 basis points to 4.2% or 4.3% as inflation pressures soften and the Fed initiates its cutting cycle. Though the upward revision is mainly an effect of higher term premium, which we expect to prove stickier than pricing of policy rates remaining high forever. Currently, we see bond holding equities in the 4,400 range during the remainder of 2023, barring a major geopolitical event or a terrorist domestic attack resulting from the Israeli-Gaza conflict, of course. As the recession becomes more obvious, PE ratios will likely fall towards 14, with yields in the 4.3 range. These are likely trends, but are not to be invested in without further confirmations. What can we conclude? Global central banks are determined to not let a recession take toll it did in the 1970s, so they will continue to tighten until something breaks and the consolidations we discussed earlier begin to happen. It is impossible to determine what will break, when, and what the powers to be will do in the way of special facilities. What is easier to predict is we have entered an era of economic stagnation and stagflation. Have you got your gold allocation yet? As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems, until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2023 turn out to be an outstanding investment year for you and your family.